The Exela stock has been the topic of many conversations lately, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile for the moment, we should always be mindful about which positions we're taking on, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Exela has brought the stock to around 26 cents, before stabilizing to around 21 cents. The Exela stock has been treading water for a long time, and one major difference setting itself from other tech names apart is that the stock has been having significant levels of volatilities ever since 2017, when it merged with a SPAC to start trading on the public exchanges. With a historically unprofitable business model and substantial shorting volume from institutional shareholders, the stock has always stood out as the David in the fight, while Goliath tries to squeeze out every penny of profit out of their positions. That situation saw some spectacular changes in recent years, but ultimately it didn't really stand the test of time. If we fast forward to 2021, the stock had a peak of almost $8 before going back to around $1. And after a few rounds of sell-off along the market going from bullish to bearish, the market price is now hovering well below $1. As things stand now, the company is still on a deficit with a significant leverage level on its balance sheet. And given that the maturity date for the loan is relatively close, this is the main issue that worries the market participants. Nevertheless, I think that the stock does still have value for traders who wish to benefit from the volatility of the market. Exela is currently trading at historically low levels, and there's an argument that can be made regarding the short-term profits from supply and demand changes, as long as we're clear about the outlook and the period through which we want to keep the position open. Now, let's also take a look at the technicals. The trading volume of Exela has recently been 65 million shares versus an average volume of 32 million shares. Over the previous 52-week period, the price fluctuated between 21 cents and $5.45. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there is a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the stock. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it's an interesting indication because it may signify that a trend reversal may happen soon. The market cap of Exela is currently at $94 million versus an enterprise value of $1.4 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company's assets once the debts are paid off. It's worth mentioning that one of the most significant assets for a lot of growth companies may be intangible, which means that they're not items or stocks that companies can use to generate income, but promises for a brighter future, like pledges for major contracts, blueprints, or quality management. For startups, most of their valuations are based on those intangibles, which may be valued in more favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that the company is trading at a discount. It's only trading below its book value, but doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and it has deflated itself ever since. As we compare the current price to the historical price fluctuations, the stock is 4% higher than the 1-month low, 4% higher than the 12-week low, and 4% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 425% versus a historical volatility of 130%. The most recent volume of options traded is 2.1 thousand contracts a day versus the 30-day average of 2.1 thousands. In terms of open interest, the most recent volume of open interest is 150,000 contracts versus the 30-day average of 170,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. It's often said that you can evaluate the likely scenario based on the opposite of what the current ratio is. If there's a lot of put options, there may be a possible uptrend on the move, or that the reversal may happen if there's a lot of call options. The reasoning behind that theory is quite simple, and this is that most option contracts would expire worthless. In terms of its shareholder structure, institutional shareholders own about 20% of the outstanding shares. The biggest shareholders include Riley Financial, Vanguard, and BlackRock. It's relevant to understand the shareholder composition of a company, as this can help us to determine if you would hold the stock long-term or to view it as a trading opportunity. If the stock is mainly held by retail traders, this may be a sign that long-term trust may not be justified yet. Typically, the consensus is that there should be between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions to this, as many great titles are also held by retail, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 8% of the total float, with 51% of the transactions coming out of the dark pools. Usually, if the short interest is above 15%, that a significant chunk of that volume are coming out of the dark pool, this may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. My recommendation is to buy the stock if you're looking for short-term trade opportunities, especially to fit the place of a fringe position in case the stock price jumps. If the aim is to purchase Exela at a good price and to keep it to hold for long-term, I would then recommend additional prudence and to diversify the long-term position significantly in terms of exposure compared to the short-term one. I would recommend to commit between 1 to 3% of your portfolio in Exela, and would also recommend to split the allocation in 10% at a time to benefit from further retracements. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses, Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.